This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by...
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
Tale of the taper. Tomorrow's Fed decision is the most highly anticipated in recent memory, and many expect the central bank to start cutting back on stimulus. But are your investments ready?
Giving back. Microsoft hikes its dividend and renews its massive stock buyback. But is it enough to get investors excited about the stock again?
5 years later, is the mortgage market any safer? And are consumers better protected now than before the financial crisis? All that and more tonight on Nightly Business Report for Tuesday, September 17th. Good evening, everyone. I'm Sue Herrera, in tonight for Susie Guerin.
And I'm Tyler Matheson. Welcome, everybody. It is almost here, and the world awaits. The Federal Reserve kicked off its two-day policy meeting today. By this time tomorrow, investors the world over will know whether Ben Bernanke and his fellow Fed heads will slow the pace of their bond buying. Now $85 billion a month designed to help the economy. So here's what the waiting looked like today on Wall Street. The Dow adding 35 points. The Nasdaq up 27, closing at a fresh 13-year high. And the S&P 500 was up 7, closing above 1,700 for the first time in 5 weeks and closed higher for the 10th time in the past 11 sessions. So will they or won't they, and what do the experts think will happen? Just out today, a CNBC poll of Wall Street pros predicts the Fed will pull back on its stimulus plans by about $15 billion a month. As for when, a majority of respondents say the Fed will start the tapering tomorrow.
And here with his perspective on tomorrow's big Fed announcement and how you should position your portfolio is Russ Kosterich. He is the chief investment strategist over at BlackRock. Welcome back, Russ. Good to see you.
Sue, thanks for having me.
Are you one who thinks that the Fed will begin to taper, and if so, by how much?
Probably, and I think it's going to be a modest tapering, which would mean somewhere in the neighborhood of about $10 to $15 billion. Starting the process, but also recognizing the economy is still getting back on its feet. The labor market is healing slowly. So I think the Fed is going to be very measured in how they withdraw monetary accommodation.
So, Russ, if this happens as you predict, what is likely to happen in the markets, stocks and bonds, and what should I do with my money?
Well, I think a couple of things. First of all, the amount of taper, again, based on the poll you just referenced, I think is fairly well discounted into the market. So if the Fed does go about $15 billion, I don't think that is going to provoke much of a market reaction. There'll obviously be color around that guidance, which might move investors one way or the other. But I think the reality is we're in an environment which is the economy is getting better. Rates are likely to continue to rise, albeit at a slow pace. So this means a couple of things for investors. One, probably overweighting equities versus bonds. Second of all, within equity portfolios, looking for stocks that are less rate sensitive, which means fewer defensives, and probably levered to more cyclical parts of the stock market.
Russ, you said that interest rates are likely to continue to rise, but what kind of a move up are you expecting? Is it going to be slow and steady? And if so, where's the ceiling on rates near term?
Well, I think it's going to be slow. Now, steady may not be the right word because, as we've seen, we're likely to have more volatility in the bond market, given investors adjusting to less monetary accommodation. But we don't expect rates to melt up. So as a rough gauge, we think rates will rise towards the mid-threes in 2014. The market can live with that, again, assuming it happens in the context of a normalizing economy. I think the risk is if rates back up too fast, and obviously the Fed knows this, you run the risk of impeding the housing recovery, which really is the one unambiguous bright spot right now in the U.S. economy.
Russ, you mentioned sort of avoiding interest rate sensitive stocks and leaning towards, I believe you said, more cyclical names. Could you give us some examples, without naming names particularly, but
Sure.
of where you find those interest rate sensitive stocks and where you find the ones that you should lean toward?
So let's start with what we think you want to be cautious on. So historically, at least, the parts of the market that have been the most sensitive have either been bond market proxies. In other words, stocks that generally trade like bonds. I put utility companies in that category, and also parts of the market where leverage is very high. So again, companies that have high leverage levels are of course going to be more exposed as the cost of money goes up. What typically is likely to do better? Again, first of all, companies that are more resilient in a rising rate environment, and companies that will benefit in the form of faster top-line growth as the economy heals. And I think in that category, I'd include technology companies, energy companies, also some manufacturing companies, particularly those that are likely to benefit from lower U.S. domestic energy costs.
All right, Russ, we'll leave it at that. Thank you so much for joining us tonight.
All right.
Russ Kocher, he's Chief Investment Strategist over at BlackRock.
And shares of the Dow component Microsoft ended only slightly higher today, despite making some bold moves and costly ones to attract more interest in its stock as the company prepares for a lot of changes in the months ahead. Our Josh Lipton has more.
This morning, Microsoft announced a $40 billion stock buyback, as well as boosting its quarterly dividend by 22% to 28 cents per share. The board approving the new stock repurchase plan to replace the previous program, which was set to expire at the end of the month. Microsoft, known for its shareholder-friendly actions, it has been paying a regular quarterly dividend since 2004. Colin Gillis of BGC Partners covers Microsoft, says he wasn't surprised by the relatively muted reaction from investors to the news.
Because they increase the dividend most every year, right? So last year in September you got a 15% increase. This year it's a little stronger. It's a 22% increase. But the yield is it's stuck somewhere. It's about 3.4% right now. That's somewhere between a 10-year bond and a 30-year bond. Now it's better than the yield that you'd get from owning Apple, right, who have just started paying a dividend, but it's lower than what you would get from owning Intel.
The news today of the buyback coming amid a lot of change at the software giant. It announced earlier this summer that it would be launching a major reorganization which would help shift the company's focus to tablets and smartphones. Earlier this month, Microsoft surprised many investors and analysts when it decided to buy Nokia's device business for $7 billion in an attempt to compete with Apple and Samsung in the global smartphone market. Then last month, Microsoft announced that its longtime CEO, Steve Ballmer, would be retiring during the next 12 months. The stock today moving higher on the news, now up over 20% this year. Last year, remember, it was up just 3%. That stock now currently on track for its biggest yearly gain since 2009. For Nightly Business Report, I'm Josh Lipton.
While Microsoft grows, the federal deficit is expected to continue to shrink before expanding then once again. The Congressional Budget Office says it expects the national deficit to decline to just 2% of gross domestic product by the year 2015. That's from the current rate of 4%. But then it's also forecasting the deficit to rise back up to 3.5% of GDP by 2023, and that's mostly due to soaring health care costs for an aging population.
And another warning to Congress, this one from the Treasury Secretary, Jack Lew, telling Congress that waiting until the last minute to raise the nation's debt ceiling could cause irrevocable harm to the economy.
If Congress does not act and the U.S. suddenly cannot pay its bills, the repercussions could be serious. The impact on families and businesses could be significant. Investors losing confidence in the full faith and credit of the United States could cause damage to our economy.
Well, the Treasury is slated to hit its borrowing limit of $16.7 trillion about a month from now, mid-October.
So between tackling the next debt ceiling deadline and reaching a federal budget deal, Congress has a lot on its plate that directly impacts the economy, the stock market, and your investments. So the big question is, are lawmakers ready to work with President Obama, and can they really get any of these deals done? John Harwood joins us now from Washington, D.C. So, John, set the table for us, if you will. Where do things currently stand?
It's pretty bleak right now, Sue. There still is some time for the House and Senate to strike a deal on extending government funding, which runs out on September 30th, but there's no sign right now of an agreement that can pass both chambers. The House is likely to pass an extension of government funding for a couple of months to allow negotiation, but attached to that, a defunding or delay of Obamacare, which is a demand of many conservative activists. That cannot pass the Senate. And so the question is, how can they get something going that keeps the government funded? And remember, 2 weeks after the government's supposed to run out of money, the debt limit needs to be raised, according to the Treasury. That's an additional problem, even a harder problem than extending funding.
So, John, tactically speaking, as you just mentioned, the House GOP are tying actions to the defunding of, in some cases calling for the repeal of the Affordable Care Act. That's a non-starter. When does that melt away as a tactical device?
not clear, may melt away once the House caucus sees that it can't pass the Senate. Maybe it melts away once the Senate advocates, like Senator Ted Cruz of Texas, try to run around and get votes for that and run up against a brick wall when they see that it can't pass. Some people think, and I talked to a Democratic leadership aide today who said it may take a government shutdown with a lot of heat being generated on the Republican Party, and that's what both sides expect would happen if we have a shutdown, before they will buckle, give up that demand.
The president, in his news conference yesterday, the rhetoric was strong. He's obviously very aggravated with the inability right now to bring the two sides together. Does either side have to soften that rhetoric, John, or try and reach across the aisle just a little bit to make some headway, or is that really off the table completely?
Well, they've got to get to a place where the offers are or their demands are things that the other side could conceivably accept. There is no possible way that a president named Obama will accept the stopping of something called Obamacare. So that's not going to happen. And the question is, when do Republicans discover that? Republicans are not likely to pass a straight, clean CR or debt limit increase, CR being a continuing resolution extending the government funding. So there's going to have to be something to change the dynamic that currently exists before we can get a solution.
And very quickly, John, the president said he will not negotiate on the debt ceiling, right?
He absolutely won't. He was burned by that in 2011, but Republicans were also burned, and that is a memory that Democrats are counting on that will impel Republican leaders to, at some point, force their members to accept a solution they don't want to accept right now.
John Harwood, thank you very much. More now on yesterday's deadly rampage at a Washington, D.C. naval facility that left 13 dead, including the shooter, who investigators now say acted alone. His actions are raising questions about government contract workers and the security clearances that give so many of them access to military or other sensitive bases. Hampton Pearson has more now on what's being done about it.
As civilian and military employees return to work at the Navy Yard today, the White House says it will review standards for government contractors after the fatal shooting of 12 people by a contract worker with a security clearance to be there.
DNI is currently undertaking a review of security clearance policy for certain contractors. And I can tell you that at the President's direction, OMB is examining standards for contractors and employees across federal agencies.
More than 4.9 million people just in Defense and Homeland Security have those clearances, according to the latest figures from the Director of National Intelligence. So, how did the deceased gunman, 34-year-old Aaron Alexis, who had 2 gun-related brushes with the law in Texas and Seattle, as well as mental health issues, get a security clearance that gave him access to a military facility in the heart of the nation's capital? It turns out the secret clearance for a civilian IT contractor is at the low end of the security bar. And security experts say, given the sheer volume of background checks, Alexis' profile did not set off any alarms.
It's not that difficult to get a security clearance if you do not have major red flags in your background. If you have anger management issues, but you've not sought treatment, if you have an arrest record that does not trigger any type of indications of violence, if there's nothing else in there, then there's no reason to deny a person a security clearance from a safety perspective.
Even with a security card, how did Alexis get a shotgun into the building? A just-released Defense Department Inspector General's report says efforts to reduce costs resulted in 52 convicted felons gaining unauthorized access at various naval facilities due to flaws in a widely used access control system. A former national security official says in the end, there is no substitute for hands-on inspections.
I think really it comes down to increasing the random inspections and not trusting anybody 100%. Understanding that anybody at any time could, in theory, be a viable threat.
Whether it's the government or private employers, security experts say possible solutions include periodic background checks, perhaps even using social media, and having an emergency plan for a worst-case scenario, a mass shooting event in the workplace. For Nightly Business Report, I'm Hampton Pearson in Washington.
Still ahead, J.P. Morgan may be in trouble again, but why does it seem different this time? First, a look at how the international markets closed today. Gasoline prices have gone where they've never gone before. AAA says that as of today, the average price at the pump has remained above $3 a gallon for the 1,000th day in a row. Now, if you're counting, the streak began on December 23rd, 2010, and since the average price at the pump is now $3.52 nationwide, look for that streak to continue for a good long time.
Well, Ty, now to the skies as Boeing's next-generation Dreamliner made its maiden flight today, taking off from a company airstrip in Seattle. This jet is the 787-9, and it's a longer version of the original Dreamliner. It's designed to carry more passengers, 290 in all, and travel 300 miles further without refueling, allowing the airlines to sell more seats on longer routes. And for more on the story, head to our website, nbr.com.
Safeway wants to prevent a hostile takeover, and that is where we begin tonight's market focus. The supermarket chain adopting a poison pill, which allows existing shareholders to acquire more stock at a discounted price to discourage a takeover by an outside entity. Now, hours after the poison pill was announced, the activist hedge fund Jana Partners disclosed a 6.2% stake in the company. Shares did gain 10% to close at $30.99. Sycamore Partners has taken an 8% stake in Aeropostale. The buyout firm calls the teen retailer an attractive investment and has a history of taking retailers private, including Hot Topic and Talbot's. Shares of Aeropostale soared 18% to $10.17.
Beauty cosmetics producer Cody reporting a higher than expected quarterly profit, but it then warned that revenue was likely to decline this quarter. The company says that U.S. customers are cutting back on purchases and that growth is slowing over in Europe. And that sent the stock lower by almost 4% today to $15.64. And Kythera Biopharmaceutics is surging after the company said that its experimental drug to treat double chins met its goal in 2 late-stage clinical trials. The stock rose 25% to $41.95. That company went public just last October.
Well, Sue, the Wall Street Journal reported this afternoon that even as J.P. Morgan Chase prepares to pay upwards of $800 million in fines to settle regulatory charges, the bank may face criminal actions related to last year's so-called London whale trading fiasco. The paper says the FBI and Manhattan prosecutors are collecting evidence that could lead to criminal charges against the firm. The company could face yet a third action tied to those trades. That one would come from the Commodity Futures Trading Commission, which regulates derivatives. Here to discuss the troubles the big bank faces is former Securities and Exchange Commission Chairman Harvey Pitt. He is now the CEO of consulting firm Kalorama Partners. Mr. Pitt, welcome. Good to have you with us.
Good to be with you.
What's significant here, sir, apart from the size of the probable settlements, and it's massive, is that the bank, in a change driven by the new SEC chair, apparently is going to have to admit to wrongdoing. How big a deal is that, and what will it mean to J.P. Morgan? For example, could they lose clients?
I think it's a very big deal. They're going to admit that they didn't discover the London whales trades quickly enough and that they had lax procedures or a lack of significant systems of internal control. Those admissions will be used in subsequent proceedings that may be brought against J.P. Morgan. So this is a major new step for the SEC and will have serious ramifications for J.P. Morgan.
And as we said, they may well face some criminal actions if the probes by the FBI and the Manhattan Prosecutor's Office bring them about, and the CFTC may do that. Are there ramifications beyond just J.P. Morgan in the fact that they're paying a lot of money to make this issue supposedly go away and having to admit some responsibility?
I think there are ramifications. First of all, this tarnishes the reputation of the bank, which has prided itself on being very well run and has that reputation. Secondly, I think for the SEC, this is going to elevate the standards that it will apply. $800 million in a collective settlement is a huge amount of money. Getting admissions from J.P. Morgan of the nature that are involved is also highly significant, and it's going to raise the bar for future enforcement actions against banks.
Turning back now to something that happened 5 years ago. It's the 5th anniversary this week of the apex of the financial crisis. So I want to get your perspective. Do you think the banks are safer today? Are the markets fairer today than they were then? And should ordinary investors have more confidence in the system overall?
I'd like to tell you that they should, but I think there are too many problems that we're witnessing. Investors are watching the markets constantly being subjected to technological glitches. Now, while those glitches are probably unavoidable to some extent, what is avoidable is not knowing how to respond when there's a glitch and not knowing how to limit the amount of damage that can be done. It appears that we're not learning a lot of lessons, and the SEC Chair White's effort to bring all the exchanges together is a great first step, but we need a lot more ultimately if we're going to restore confidence.
Mr. Pitt, thank you very much as always for being with us tonight.
My pleasure.
Harvey Pitt's former SEC Chairman and now the CEO of the consulting firm Kalorama Partners.
Coming up, with new lending rules set to take effect, is the mortgage market safer than before the financial crisis? We'll look at how things have changed and how they've stayed the same. First, though, a check on how commodities, treasuries, and currencies performed today.
Only 98 days until Christmas, and already predictions of a slowdown in spending growth. The research firm ShopperTrack says retail sales are expected to rise less this holiday season than in recent years because many customers are still a bit cautious with their money while the economy slowly recovers.
Well, 5 years after the financial and fiscal crisis and the crash of the nation's credit markets, new lending rules are set to take effect just months from now. They're designed to protect borrowers and investors alike. Some say it's the start of a safer mortgage market. Others argue, however, the nation is no better off than before, and that raises the question, can the housing market collapse again? Diana Olick finds some answers.
We didn't need a sign or thousands of signs like these to tell us that during the housing boom, lenders paid little attention to what their borrowers could and could not pay.
Somehow big swaths of the mortgage market as it existed then had forgotten that basic rule.
That's why Congress added the so-called ability to repay rule to the recent financial reform legislation. All lenders must now look at all of a borrower's finances to determine if the borrower can repay the loan.
I think we've gone full circle back to having the customer at the center of ability to repay, making sure they can have sustainable home ownership, rather than necessarily having products that investors will buy that may not make sense for the customer.
We did not have this 5 years ago.
Wells Fargo now takes borrowers through clear steps to determine which loan product is right for them.
This is specifically in reaction to what we learned from consumers about what they want to make good decisions.
And there are also new rules to protect lenders. The Consumer Financial Protection Bureau, or CFPB, created the qualified mortgage. A QM mortgage must meet several standards, which include that a borrower can pay no more than 43% of income on debt. The loan also cannot have certain risky features that were popular in the last decade. A QM loan gives mortgage bankers protection from borrower lawsuits and can be sold to Fannie Mae and Freddie Mac.
We've created more rules and regulations to protect the consumer than have been applied in this industry in the history of mortgage banking today. Are there still going to be unforeseen risks? Absolutely.
And that's where critics argue that QM, by giving safe harbor to lenders, leaves borrowers in the lurch yet again.
If you get a certain kind of loan that meets certain terms, you have no recourse against the bank. That should never be the case.
Big lenders like Wells Fargo will do the bulk of their lending in the future under these strict new regulations, but they can also operate outside them. It's perfectly legal. They just have to hold on to more risk.
These are important changes for consumers.
Raj Date, one of the architects of the new rules, left the CFPB to start a firm that will lend to borrowers who don't meet QM standards. The loans will be more pricey.
Non-QMs are the only place, if you want to make decisions and bear the risk and reward of them, where you can count on actually getting paid for taking good risks, you have to be a non-QMs, and that's where we are.
And that's where the greatest risk could lie in the future.
Where I think we're going to see the worst behaviors in the marketplace are new breeds of companies coming into the non-qualified mortgage area where they can see much higher yields.
The difference today, though, is that mortgage investors will have to have skin in the game. Instead of betting on rising home prices, they'll have to ensure their borrowers can pay and face the consequences if they can't. For Nightly Business Report, I'm Diana Olick in Des Moines, Iowa.
What a concept. Banks that have to make sure that their borrowers actually can repay the loan.
Can repay the loan, I know.
It's an amazing idea.
I hope they get it right this time, because
Absolutely.
I certainly don't want to go through what we went through the last time with the housing crisis. And we've seen
sure.
several of those in our time, I think. All right, that's Nightly Business Report for tonight. I'm Sue Herrera. For more on the business stories that we've covered tonight, head to our website, nbr.com.
And I'm Tyler Matheson. Thanks for joining us tonight. Have a great evening, everybody, and we'll see you back here tomorrow night. Big Fed Day tomorrow.
Yeah.
Nightly Business Report has been brought to you by
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
I'm Tyler Matheson with a Nightly Business Report news brief. The Federal Reserve kicked off a two-day policy meeting on interest rates and to decide whether to begin pulling back on its $85 billion a month in bond purchases to boost the economy. Wall Street wasn't too worried, it seems, though. The Dow added 35 points. The Nasdaq was up 27, closing at a fresh 13-year high, and the S&P higher by 7, back above 1,700 for the first time in 5 weeks. Microsoft is boosting its dividend by 22% and buying back $40 billion of its own stock. And inflation is in check. Consumer prices in August rose just 0.1%. Home builder sentiment stayed the same this month, near an 8-year high. And AAA says gas prices have now spent 1,000 days in a row sitting above $3 a gallon. Tune in to Nightly Business Report right here on your public television station.